Welcome. Thanks for joining Josh and I today. We have another opportunity this week. We felt we hit a little bit of a low spot there, and now we're starting to see things kind of pick up and good progress on finding opportunities out there. And this one's right by our house.
Right, yeah, it makes it a little bit convenient to go check out and do our inspections and all that.
Yeah, so we have a new industrial flex deal. It's called Plesantdale, and it's right here in Atlanta, more specifically Doraville, which, if you've been with us for a while, Doraville is where we bought like one of our very first apartment deals.
Foxwood, number 6. God, we had so I think our first office was at Foxwood, maybe our second office.
First office was at Foxwood Apartments.
We had a couple toilet issues at that property.
We spent a lot of time there. That was a great deal for us, and it was right here in Doraville. So we are back in Doraville. We love the 85 corridor. We've talked about that for years. I think we've been investing here for almost 15 years in this specific area. And now we've done a mix of the multifamily assets, retail, and industrial buildings that are in this area. This will be our fourth asset that we currently own. We've done a bunch of others in this area. We own 4 right now, including the building we're at, right in the area.
And then the other 3 we bought this year was Doraville Flex. We bought Technology Parkway Flex, and then Dawson Flex that a lot of you guys invested in. You know, all of which are way ahead of schedule with our plans and lease up and renewals with those tenants in there. That basically excites us for this market.
Yeah, that's why we like this part of the Atlanta so much. So Plesantdale Flex, this is a 55,000 square foot building. It's currently fully occupied, but we're getting at a little bit of a discount to other stuff we've purchased. Our basis in most of our other deals around here is around $120 to $130 a square foot, and we're acquiring this one for $95 a square foot. Part of that, though, and it's fully occupied. So it's like, wait a minute, why is that at a discount if it's fully occupied? But the rents here are between $3 and $4 full service.
Yep.
Right, so no cost reimbursements, no anything, just $3 to $4. Owner's paying all the costs associated with it.
Right, and we frequently see this with long-term owned buildings that the owner bought 20, 30 years ago, and they like the cash flow. If their cost base is low enough, they don't have a lot of debt on the property. So it works for them. Obviously, it won't work for us, but it's been working for them for a long time. So it's a good opportunity for them to turn over when ordinarily it'd be a very difficult transition for them to turn all these tenants over. We can come in with a fresh capital stack, fresh ownership, and
it costs a lot of money too.
Yeah, it costs a lot of money.
It does cost a lot of money if you're going to go in and say, hey, I'm going to change over a tenant that's paying rent. I'm going to spend money. Sometimes people are hesitant to do that, but this is exactly the type of deal that we want to be able to find. It needs some love on the outside and making it look clean and more usable for a tenant that's here. It has a long-term owner that's owned it for over 20 years, and it shows that it needs some improvements.
Yep.
So, but we think about $95 a square foot and why we're getting that price, and we mentioned $4 in rent or $3 in rent. The market that we are seeing is around $10 to $12 a square foot in rent. So that's a large gap between what's currently there and what we think the market is.
And the $10 to $12 are triple nets, meaning that it's $10 to $12 to the tenant plus the cost of operating the property. We pass that all the way through the tenants. So again, to Dave's point earlier, they're currently paying $3 to $4 full service, meaning that they're not paying any of those reimbursements. And the market is paying $10 to $12 with full reimbursement.
That's part of why the value is lower, though. If you're looking at this deal and you don't have a bunch of capital that you want to invest in something, and you're only going to get $3 to $4 in rent, like you're really not going to be able to cover much. So therefore, when we look at our investment, the deal is essentially cash flow negative when we buy it. Right? We're not going to be cash flow positive with rents in the $3 to $4 range. That's not going to do it. So our strategy here has a couple phases. The first phase of it on the acquisition is just acquiring it and figuring out what's going on. And then we'll go through really the improvement phase and then another lease-up phase.
Yeah, with the improvement phase, we like to show, we like to show the community, we like to show the existing tenants that we're going to put money into this property, we're going to take care of this property, and we're going to make it a better place to do their business in. So that when we go to them for that renewal package and say, hey, you were paying $3 to $4, now we need you to pay closer to $10, they can see that we're putting our money where our mouth is.
our plan here is basically we're at $95 a square foot. We'll have about $5 a square foot in closing costs, and that's typical kind of on our deals. We have $11 then allocated to do improvements to the property. And this includes everything from making the facade look a lot nicer. It definitely looks worn. I mean, it's been around for a while.
It's an older
It's
building.
the building we kind of like buying, an older building. So we're going to fix up the outside of the facade. We've got work we're doing on the parking lot, straightening everything up, repainting the lines, and then doing a good amount of landscaping to, one, just help it look nice from the street. So with that work, that'll add about another $11 a square foot. And times 55,000 square feet, we're looking at about $600,000 that we'll spend in improvements to the asset on that front. When we get into the second phase, which is if an initial tenant says, hey, we are not going to renew at the new $10 to $12 rate, we're going to go into those spaces and renovate those spaces. And we have done that, the other assets we have right here. That's been our game plan as well.
Yeah, the Doraville Flex property that we bought, I believe we closed in February, it's 25,000 square feet that was fully vacant. And we went in and we renovated some of the space, cleaned up the outside, and then went to market in, I believe it was 45 to 60 days, we were fully leased. The demand was so high at full market rents.
Right.
With minimal concessions and 3 to 5 year leases. So we're very bullish on the ability to basically capture the market here and execute our business plan.
Yeah, it's exciting to be in an area that all that is happening. So, and the industrial flex space has been good with demand. And when we think about demand, really what's happening is this building in the area around it was stuff being built 40 and 50 years ago. It's still functional. It still has dock-high doors. It has 18-foot ceilings. It's a very functional, big facility. You can easily back an 18-wheeler into the back of it. So it's a big space. However, all the stuff around it is essentially developed. There's no real space left to add anything else. And the area that we're in is one of the fastest growing counties in the state, one of the fastest growing areas in the country. So we have a lot of population growth with not really more land to build anything. So you can't add another building like this in the area we're at. So you're limited on space. That's one of the reasons we like Doraville just in general, is it's pocketed right at 85 and 285, where there's a ton of traffic, sometimes annoying, but there is a ton of traffic and people going through this area. So,
and you know, between the major distribution hubs in Atlanta, you know, you're looking at 285, you're looking at 85 going northeast. You also have 141, which is Peachtree Industrial, which it's just a giant industrial corridor that has access to all these properties. So you know, the 18-wheelers have so many options in this specific corridor of Atlanta that drives the demand for industrial.
yeah. So talking about the lease rates, what we're aiming to get is this $10 to $12 a square foot. And then we're going to add CAM onto that. And we're also going to add rent escalations. So each year we'll have a rental rate increase that applies to the deal. So although we're buying it cash flow negative in the beginning, once we complete our improvements, we should be earning around 10 to 11% a year cash on cash. That's our plan. Now, part of those improvements too, to get that higher rental rate, we have to do improvements to the interior of the building. So we have another $11 a square foot allocated to making interior improvements and leasing commissions for these tenants. At 55,000 square feet, we will have, the building is currently 4 tenants. So we may use that space, we may break that down even further. But with those, all of those tenants at that size are going to have a leasing broker that's associated with them. That's our experience in the market. The only time we really don't have a space with broker representation is under 2,500 square feet. Sometimes some of our smaller 1 or 2 office buildings will have that, but for the most part, the broker helps really make sure that that transaction is going to happen.
It speeds it along. It makes it much more efficient.
Yeah. So total capital stack now, we have the $95 going in, $5 for closing, $11 for exterior improvements, and $11 for interior improvements. That's our plan. That brings us to $122 a square foot. That's our target basis on this deal, and that's right in alignment with other deals we have in the area that not only we have bought that, but that have also transacted.
And we've seen exits on some of these properties, you know, depending on the tenants and the mix, but we've seen exits north of 150 a square foot. So we feel like this 120 range is a really good space and not only holding cash flow, but also it's a good valuation to eventually exit in.
If we look at the investment overview as a whole, we're looking to put about $2.3 million of equity into this deal, and we'll have about $4.5 million of debt. That's our full capital stack that's going into it. And part of that is a little bit of the construction loan component of drawing up funds as we use them to make these improvements.
Right, and what we're seeing right now with lenders is generally 65 to 70% leverage on the as improved value, which allows us to draw up our capital improvements. And rates are give or take 5%. On the high end, 5.5%. On the low end, maybe you squeak out a 4 3/4. But that 5% is kind of our peg number, and that's normally we get 1 year of interest only, and on a 25-year amortization. We always like to fix our debt instead of floating it, especially in today's times. So we always look for kind of a 3 to 5 year fixed debt option that we negotiate with our lenders.
This could be the end of the 5% and below debt. We've been talking about that. When does debt in the 4% range end? And we just did a retail deal that we were working on that was at 4.85. So we feel like we're sneaking in these deals that are in the 4% debt range, but we do not really expect this one to fall in that 4% range. So we're targeting the low 5s as more as a reasonable expectation of what we're going to get here. But with that target and with our equity chunk going in, we still expect to see about 11% cash on cash returns as we're able to complete the initial acquisition improvement phase and full lease up. So that'll take us about 18 months to get there. All of the current tenants that are here have leases that expire within 1 year. So,
and the benefit of the current tenants is they'll cover our costs while we operate the property, and one by one we'll take their unit down, we'll renovate it, and then we'll work on the lease up. In general, we're seeing lease ups take about 60 days for space this size. So we budgeted 6 months to basically take the unit down, renovate it, have 60 days kind of lease up window, and then get them to start paying rent.
Yep. Okay, that's it for Plesantdale. We're excited about this one. It's been a little bit since we've had a flex deal that we've been able to find at a good price point. So we're excited about this one. We know we can execute because it's right in the same area that we've been operating in now for almost 15 years, which is crazy. It's a long time. So thanks for watching. Please let us know if you have any questions, and we'll be sending out more information on the Plesantdale Flex opportunity soon as well. Thanks.